Here's something nobody wants to say out loud. The market feels wrong right now. Not crashing, not euphoric, just off. Like that moment when you're driving and you hear a faint sound from the engine. Nothing alarming, no warning lights, but something in your gut tells you to pay attention. You're not imagining it. The S&P is sitting at nearly 31 times earnings, almost double its long-term historical average. Nvidia trades at 47 times earnings. Palantir sits at around 400 times earnings. And most investors with serious money are doing one of two things right now. Either they're pouring more in because momentum feels unstoppable, or they're sitting on the sidelines watching, too nervous to buy and too greedy to walk away. Neither of those is a strategy. Both of those are emotions wearing a suit. Here's why this moment matters more than most people realize. We just came off several years of outsized returns driven by a very specific story: artificial intelligence, big tech dominance, and the Federal Reserve finally pivoting toward cuts. And that story isn't over. But it's entering a new, messier chapter. The investors who built serious wealth over the last decade did it by reading the book. Maybe NSITONs correctly, not by predicting the future perfectly, nobody does that, but by recognizing when the environment was shifting and adjusting before the crowd caught on. Right now, we're in one of those moments. The signals are mixed, the headlines flip every 2 weeks, and the conventional wisdom is split right down the middle. And historically, that's exactly when smart money either gets ahead or falls behind. The S&P 500 is supposed to represent broad exposure across American industry. 500 companies, diversification, stability. That's the pitch. Except right now, just 7 companies account for over 35% of the entire index's total market cap. And through most of 2025, those 7 companies drove over 40% of the S&P's total returns. Think about what that actually means for your portfolio. If you own a standard index fund, something millions of sophisticated investors hold as their safe allocation, you don't own the American economy. You own a highly concentrated bet on a handful of tech stocks wrapped in the packaging of diversification. And because most index products are market cap weighted, every dollar that flows into them automatically buys more of the biggest stock. Be AUX, which makes the biggest stocks bigger, which gives them more weight, which means the next dollar buys even more of them. It's a feedback loop that works brilliantly on the way up and becomes a wrecking ball on the way down. A 10% correction in Nvidia doesn't stay in Nvidia. It bleeds into the NASDAQ, bleeds into the S&P, and suddenly your diversified portfolio is having an existential crisis. Now here's the bullish side, and it's real. The Fed delivered 3 consecutive 25 basis point cuts to close out 2025, and the consensus heading into 2026 is at least one more. Lower rates mean cheaper borrowing. Cheaper borrowing means higher valuations. Higher valuations mean investors get more comfortable paying premium prices for future earnings. That's the tailwind bulls are riding right now, and it's legitimate. But here's the nuance most people are skipping over. Rate cuts are a stimulant. They work, but they work with a lag, and they come with a condition. The condition is that the underlying economy needs to be healthy enough to absorb that stimulus. Think of it like taking a painkiller for a toothache. The pain goes away temporarily, but the tooth is still rotting, and markets too. Be hat rally purely on rate cut optimism while ignoring deteriorating fundamentals have a history of waking up very harshly to reality. Here's what I think is the most likely outcome in 2026, and I've barely seen anyone talk about it. Not a crash, not a melt-up. Something far more psychologically punishing than either of those. A long, grinding, choppy sideways market. Picture this. Markets rally 6% over 6 weeks. Confidence creeps back in. You start considering adding to your positions. Then they give back 5% over 3 weeks on some macro headline. You hesitate, then they bounce again. You chase, then they stall. Repeat this cycle for 12 months. At the end of the year, the index is up maybe 3%, maybe 4%, but your portfolio is down not because of the market, but because of the decisions you made inside the noise. This is how choppy markets destroy wealth without ever actually crashing. They don't kill your balance, they kill your discipline. There's a pattern I see repeat itself constantly, and it doesn't matter whether we're talking about someone with $600,000 or $6 million. There's a moment, usually about 18 months into a period of uncertainty, where people stop making decisions, be ends based on their investment thesis, and start making decisions based on how they feel when they open their brokerage account in the morning. That shift is invisible when it happens. You think you're being analytical, but you're actually just responding to pain. The investors who come out of uncertain periods stronger aren't the ones who predicted correctly. They're the ones who had a plan before the uncertainty arrived and were disciplined enough to follow it when everything around them was screaming to do something else. Your edge in 2026 isn't information. Everyone has access to information. Your edge is behavioral. That's not pessimism, that's preparation, and there's a difference. So here's where we land. Three things are true simultaneously right now. Valuations are stretched beyond historical norms. The rate environment is genuinely supportive, and the most likely path forward isn't clean enough for either the bulls or the bears to feel comfortable claiming it. The question worth sitting with isn't whether the market goes up or down this year. It's whether your portfolio is built to generate returns in a world where the answer is neither for a while. Because if your strategy, why only works in a straight up environment, you don't have a strategy, you have a bet. Something feels off about 2026. Maybe that feeling is wrong. Maybe markets rip higher and we all look back in December laughing at the anxiety. But I'd rather be the person who acknowledged the signal and prepared than the one who heard the engine sound and turned up the radio. Drop your take in the comments, bull, bear, or stuck in the gray area like the rest of us. If you're thinking seriously about how to position through this kind of environment, this channel is where that conversation lives. Something's coming. The question is whether you're ready for it.